So let me just run through what we have covered. Okay, so we've covered the firms and the market structures. We are clear on that. I think maybe our next, I still have one more class with you guys. Let me see if I can get questions. I'll try to get a lot of questions. I already got a few. So I want to see that I'll solve some questions on that type of issues. And then you see your score. Okay. So we've done firms and market structure. Remember this one, which is also what we're talking about. Different kinds of firms. The perfect competition, monopolistic, monopoly, and the rest. Then we move to business cycles, where we say businesses face different kinds of cycles. Some are the expansionary cycle, the contractionary cycle, control, and the rest. We spoke about that. And then we move to fiscal policy, where I said there are two policies that government and the economy uses. There's fiscal policy, which is what government uses, and there's monetary policy, which is what CBN uses. So currently in Nigeria, majority of almost every day, I was still discussing with my company people, almost every day, what was that guy's name? Cardoso, CBN government, he's bringing up one policy or the other. I wonder if he still is sleeping himself. There's one policy, almost one policy every day to try to fix the economy. So that's the monetary policy we have spoken about. I remember we said these policies end up in two things: to manage inflation. The aim of CBN is to try and manage inflation. If you want more money into the economy, inflation will go up. If you try to take money out of the economy, inflation will go down. In an ideal situation, don't use Nigeria for your CFSR. In an ideal situation, that's what we have spoken about. So any policy you see that we are talking about, you have to ask yourself, this policy, is it trying to reduce money in circulation or increase money in circulation, which also leads to inflation and development. Then we came to geopolitics, and I said geopolitics is one of the new areas that just came into CFA. It wasn't there that in 2020, 2022. So geopolitics is basically just looking at different countries and their interaction. So some countries want to interact more with themselves, depending on economic policy. Some countries say, no, I don't want to have this interaction with you. I want us to use one. There are some countries now that are no longer indexing to the dollar. They say they don't want to be involved with dollar again.
You think so?
Yeah? Yeah, I think. So some of those things are a result of some of this globalization and the rest, because dollar movements begin to affect them, whether they like it or not. Nigeria too, one of the major costs of cement industry is gas. Gas is paid in naira, but it's indexed to the dollar. So anytime dollar goes up, gas price will go up. So if really they want to fix that cement market, first thing to do is to pay the gas at a particular price. Once they do that, a lot of the things in the economy will be discussed. Gas is the cheapest source of power. It's one of the cheapest source of power. Instead of using diesel, alternative fuel, and the rest, those ones are very expensive and they have effects in the environment. So gas is supposed to be the best. But gas is now getting very expensive. You get it? If you buy gas in your house, the gas you bought last month or last 2 months, and the gas you are buying today, you know that it has increased. The price of gas has gone up. So that's affecting that. So that's the geopolitical environment. We spoke about international trade. International trade, we said one country is trading with another country. What are the factors? How are the ways? What ways can they try and restrict one or two things? We spoke about tariffs. We spoke about quota. So can somebody tell me what tariff is and what quota is? Yeah, so tariff is saying, government is saying, okay, no problem, you want to import this product, no problem, I will charge you, for example, 2% of whatever you import. So everybody knows that If I don't want to give government so much money, I will reduce my importation. Or I keep importing and I transfer all the costs to the final consumer. So if the consumer is still willing to pay for it, fine. If the consumer is not willing to pay for it, then I reduce my quantity. We spoke about quotas. Quota is that in terms of quantity, this is the maximum quantity I want you to import into the country. This one is not about how much you pay. You don't import more than 200,000 tons, for example, of this product. Then export subsidies. Export subsidies, government is encouraging you to take things out of the economy, which is one of the things we should be doing in Nigeria, so that we can get dollar into the country and then we stabilize the economy. Because we don't really have things to export. That's one of the reasons why we're in this situation. We are too import dependent. So we spoke about how this affects quantity demanded. And we said for tariffs, if for example, I think there was a point where cigarettes had tariffs on it. So people import low quantity of that. So for the demand, if the quantity demanded is 100 without tariffs, once tariff comes in, this quantity demanded will reduce to maybe 90 or 80, for example. Why? Because not everybody will be willing to pay that extra tariff that government is charging in terms of the final consumer. So therefore, the overall quantity demanded in the economy will reduce. Now, if the quantity demanded is reducing, the question is, does this now cover what the citizens need in the economy? Right? So there is now a local production, just like rice. We import rice, right? And we also make rice local. But the question is, the importation of rice, is it sufficient to meet the needs of everybody that wants to eat rice? We could answer it. So meaning there is a demand gap. How do we fill that demand gap? We now have a situation where we have local production. Can we pay attention, please? We now have a situation where local production has to try and meet up. So let's say this tariff reduces this from 100 to 60, right? We have a 40, let's say kg, let's call this kg. We have a 40 kg gap. The local production will try and fill this 40 kg gap. But people still want rice. That you have added tariff to rice does not mean I will decide I want to stop eating rice. I still want to eat rice. But I may now have to reduce my quantity of rice I eat because now I know rice is more expensive. So now this local production, the quality of this local production may not be the same as the quality of this imported. Most likely it's not the same. However, because there is a gap here, it means this local production, what would they do? They will increase their price. Because they know people will be coming for I want rice. Imported rice don't finish, only local. We just give me local. So there will be more demand for the local. And when there is demand, there will be price increase. When demand is more than supply, they will increase the price. So these local production guys, they usually gain when there is a tariff. Do you get? They will gain because of this gap that has been created, this demand gap. You get the point. So now local rice, I don't know how much local rice is now, but it's very expensive. It's not like the quality has increased, but the price has gone up because of this imported price too that has also gone up and quantity has come down. So there is this gap here. So same as quotas as well. If government says, oh, the maximum I want you to import is 50, it means there is a gap between this and this. Who will fill it? The local production guys. So what does it mean? Anytime we introduce tariffs of quota, it means that one, these local producers they gain. Right? One. Two, prices will go up. The price of the product itself will go up. One, as a result of the tariff. Two, as a result of the fact that these producers want to take advantage of the market, that there is demand and there is no supply. Do you understand? So their prices will go up. Demand will come down. and then consumer. So we as consumers, we will lose in this situation. Why are we losing? Because something, for example, we're buying 50 naira, we're now buying it 80 naira. Right? So we are paying more because of this tariff or this quota. Clear? So that's one of the things that CFA will ask you. How does this affect demand? How does it affect price? How does it affect producer surplus or consumer surplus? That's what I've tried to explain here. Export subsidy is very easy. You are encouraging the country to export. So government should need to give subsidy to export. So that one is clear. So in all this, at the end of the day, this international trade, trading blocks and the rest, the idea is now, are you encouraging the economy? Are you encouraging your government to trade, to do more international trade? Or are you discouraging it? Remember when we spoke about different in geopolitics, also in international trade, the different kinds of relationship between countries. We spoke about globalization. We spoke about Otoski economy. Some economies are close to others, they don't want to deal with you. They are self-sufficient. Some economies want to have interaction with you. So all those interactions are linked to these international trade tariffs and all. Clear? Is it clear?
Yeah.
Alright. So number 4. Number 4, number 5. So we're answering it together. Page. You'll be able to see more first. I don't know if that was going to. Yeah. Okay, what's the answer to number 5? No answer for me. So do we understand what the question is saying? Said B. Okay, so let me understand why B. What's the question trying to say first? Not improve welfare. Greatest welfare loss. So which of the following trade restrictions is likely to result in the greatest welfare loss for the importing country? Okay. C. The voluntary export restraint. What's voluntary export restraint? It means you are telling yourself that you don't want to export more than normal quantity, right? Just like the example we gave, I don't want to export more than 200,000 to the other country. So the price increase induced by restricting the quantity of imports. That's quota rates for equivalent quota across the tariff across the foreign exporters of the foreign government. This is also, let's go back. Do you understand the answer?
No,
so let's go back. Which of the following trade restrictions? We got number 4, okay?
yes.
Number 4 is A. What did you guys do? Big A. So, which of the following trade is likely to lead to the greatest welfare loss for the importing country? Now, so one country is exporting to another country, right? Now that country exporting is saying, I want to restrict myself for the quantity I want to export. So let's say I'm the exporting country, he is the importing country. I want to reduce the quantity I export to him. What's your name? I want to reduce the quantity I export to Tosin. Now, what does that mean? And Tosin needs my products. Right? So Tosin is the country that's going to use my products. But now it's not getting enough of that product that he needs because I'm doing a restraint. So I'm enjoying myself, but I'm stressing Tosin as a country because let's say they need 500,000. Let's say rice they want. They need 500,000 kg of rice, right? But they cannot produce everything in their country, so they are importing from me. I'm saying the only thing I want to export to Tosin is 200,000. So already there is a 300,000 gap for Tosin's needs, right? So what Tosin can only gain is what the local production can give him in addition to the 200,000 I'm giving. So there is a loss that Tosin is experiencing. That's why I say greatest welfare loss for the importing country. Tosin is the one importing from me. So he's going to lose because he's not going to get all the quantity he needs to satisfy himself. Just like Nigeria now. The rice price is going up. 1, because of dollar. 2, because supply cannot meet demand. So that's why we're experiencing, you can call it a loss, we're experiencing increases in prices because you cannot meet the demand that you have. For the tariff does not involve, the tariff here is for me, basically. And then the tariff also means I'm increasing price. It doesn't mean that you will not stay import the 500,000 you need. You get. So you are fine.
I was thinking that exports, it's voluntary export is it's for the same importing country. Maybe they restrain themselves from exporting some goods rather than.
No. Because this is for the importing country. See this last part, they say for the importing country, the country that is importing. Which one affects them the most?
It's the voluntary of another country.
Because at the end of the day, you are not getting the quantity you need of that raw of the goods. You are not getting enough of what you need of that. So even if you have your own restraints or whatever, it doesn't still solve that problem that you have. You get what I'm trying to say? Okay. So let's move. So we can keep the questions to, I think we may have some time next week. Okay, so capital flows and the FX market. So we're already almost familiar with what is happening in FX. So when we talk about exchange rate, so you know when you read exchange, what is happening with FX in Nigeria? There's a difference, we'll get to the topic, but there's a difference between Naira is depreciating and dollar is appreciating. I hope you know that. I hope you know that. So when we get to currency exchange, we'll talk about it. So yes, it's not favoring us, but there's a difference in how you call it. So is it Naira that is depreciating or is dollar that is appreciating? It's almost the same thing. There's a bit of difference. Yeah, but there's a little difference in it. When we get to currency exchange, we'll see what happens. Because in your CFA, they will ask you to explain. So now that dollar has moved, Naira to dollar has moved from 1,005 to 1,006. You need to explain that. Is it that Naira has depreciated or dollar has appreciated? We'll talk about that. Okay? So here it says describe Naira.
I said it's higher than.
Exactly. Describe the foreign exchange market, including its functions and participants. Distinguish between nominal and real exchange rates and calculate and interpret percentage change in a currency relating to another currency. These ones are almost very simple things. You don't get a lot of questions from these chapters, but these are things that once you know, it's a simple 1 or 2 marks. Very questions on that. So, okay. Foreign currency markets serve companies as individuals and purchasers. So we know what foreign exchange is. We know what forex is. One country to another country. Now, one of the things we also need to know is that there are ways to hedge your risk. What do I mean? So today now, I'm going to check the FM. What's the dollar today? Let's assume it's 116, right? I can decide to go into a contract with Biodo now. Biodo is the US one. Go into contract with Biodo that Biodo wants to buy something from me. Biodo says, okay, no problem. I said, okay, I want our exchange rate to be 1,006, which is today's rate. But I'm going to collect the item by April. Biodo says, okay. I say, okay. Why is Biodo saying okay? Why am I even entering this transaction? I'm entering because I believe that 1,006 will favor me. If I wait till April when I need those goods, it would have gone to 1,008. I will have to pay that 200 naira per dollar difference multiplied by the quantity. And I don't want to do that. So what do? I will hedge my risk and lock transactions with Biodo today. So by 1st of April, if the price is 1,000 naira, 2,000, nothing concern me, I'll smile to the bank. I'll just go to Biodo I'll sign an agreement 3 months ago. Give me my goods. And Biodo will give me my goods. And then I'll carry those goods and happily go and sell it in the market at 1,000 naira, which is the price today. So I'm making my normal profit and I'm making an exchange rate of 300 and more. Right? Why would I do that? I've explained why I will do that. But why would Biodo do that? So let me give you this 1,006. Let's make it 2,000 round figure. This is today. This is April. So there's a 400 naira here. And I want to lock this transaction today. But I'm going to collect whatever I'm buying from Biodo in April. So I'm doing this because I believe that this is going to go up. Right? So it favors me to lock this today. But the question is, why would Biodo decide to lock it today? If Biodo also believes with me that this will go to 2,000, Biodo can easily just wait and say, no, I don't agree. Come back in April when you need it, and Biodo will gain more money here, right? But at the end of the day, if Biodo does this transaction today, Biodo is going to get his cash today. Let's say the quantity we want to do is 10. So this is how much? 16K. Sorry. So this is 16K. So today, Biodo will get his money and do what he wants to do because his dollar is still intact. Right? Biodo's dollar is still intact. But if you also come here, you know at the end of the day, whether it is here or it's here, Biodo's dollar is the same from Biodo's perspective. Do you understand what I'm trying to say? Am I confusing anybody?
Yes. Because I already saw that.
Okay.
The rate is important.
Okay. So let's take, you want to buy something and it is 1,600. Today is 1,600 per dollar, right? You want to buy 10. So this will be what? $10, right? Okay, now. It will be $10, but it will be what? 16,000 naira today. Is that clear? Biodo will have to remove 16,000 naira from his pocket. Sorry, I will remove 16,000 naira from my pocket, convert it to $10, and give Biodo how much? $10 today. In April, this has gone up. $10 has not changed. But now I have to bring out how much? 20,000 naira. Biodo will still collect his $10. But me, I'm having to bring out more naira to be able to give Biodo the same $10 I would have given him today. Is this clearer now?
Or if Biodo is collecting naira.
Biodo is not collecting naira. No. If Biodo is trading naira, then there's no need to talk about dollars. I'll just give him my naira and move on. Now, Biodo will also not collect naira because Biodo is collecting money to spend. Is he going to spend naira and US? No. And I'm not going to transfer exchange rate risk to him. If I give Biodo naira, Biodo will now go and be looking for where he will get dollar to spend. Biodo is not interested in that. Biodo's interest is, you want to buy a truck from me, it's $10. Full stop. Whether it's $10, whether it's today or tomorrow, it is still $10. So you see there is an exchange rate movement here. There is a risk that this will go from this to this. But that risk is only affecting truth. It's not affecting Biodun. Biodun will collect his 10. Even if this goes, let's even say this goes down to 1,000. How much will Biodun collect? $10. It's just that me, I will now bring 10,000 naira. Biodun's own is not changing. This dollar we are shouting, they are not feeling it in the US. We are only feeling it because I'm only feeling it because I buy something from Biodun. If I don't want to deal with Biodun, I go to Tose, my guy in Naira, and I deal with Tose. Tose give me, I tell him, Tose tells me it's 10,000 naira. I come tomorrow, it will still be 10,000 naira, except when inflation comes in. I'm not talking about inflation, but normal exchange rate effect. It will still be 10,000 naira. You get what I'm trying to say? So this is the dollar effect, but this is only affecting me because now I'm having to bring more naira to settle the dollars. Do you understand? So that's what I'm trying to explain in the foreign exchange markets. Now, I said I'm doing this deal today because I'm trying to hedge my risk of the future. That if dollar goes to 2,000, let me say, see, we have only used 10 here. Imagine this is 1 million. If this becomes 1 million, the multiplier effect here shoots as well. So I'm trying to say, Biodun, I want to lock it. If you don't worry, I'll give you the $10 today. Because I'm afraid of what will happen tomorrow. So I'm hedging my risk. But if this goes the other way, you know I'm losing money. Right? Because if dollar goes down to 10,000 naira, and I've paid 16,000 naira, I've lost 6,000 naira. It doesn't affect them. So this is the exchange rate story. Is it clear? Okay. So this is the zone. Many companies have foreign exchange rates arising from cross-border transactions. A Japanese company that expects to receive it when a transaction is completed in 90 days has this rate. So it goes both ways. It's a case of me paying. I'm paying Biodun, and Biodun is also receiving from me. So this one I've explained now is the naira effect. There is also a dollar effect. What if dollar changes? It will affect him as well. You also want to hedge that rate. Yes. Exactly. So there's a difference between naira depreciating and dollar appreciating, or whichever way. Okay? So what we have entered into, so that's it, by entering into a forward currency contract. So another thing to do is that I can say, okay, this, I want to deal with Biodun in April. And Biodun doesn't want to collect his money today, he wants to collect his money in April. But how do I hedge this risk?
Surely, I think I want to diagnose it. So I think the reason why then, right, what they're showing is what they do is that the reason why we use USD dollars for because it's one of the stable currency of all currencies.
Yeah.
So they don't expect it to be fluctuating the way other currencies.
Yes.
So today now, if I want to do transaction with Chinese, right, instead of giving them their yen, like, I won't give them their yen, but I don't trust
Exactly.
their currency. Everybody trusts yeah. I'll rather pay them in US than the rand.
So you have, that's what you call it, universal currency. So dollar is going to be universal currency. Dollar, pounds, people behave they are more universal currency because they are more stable. So they can both agree to meet. I'm bringing naira, you are bringing yen, or we agree to meet at the dollar. But you know, dollar is something we can both fix and peg our currency to. But that's we need to change the bit as well. So yes, we need to change the bit as well because everybody is feeling a bit of it now, every country. Only that Nigeria needs water. But Canada is feeling a bit of it in terms of cost of living and everything. UK is feeling it. US is feeling it. It's everywhere. So because of that, and so other countries already have foundations to support some of these things. If you go to US and UK, they have funds they have set aside for things like this. When UK is saying you want to give every household a particular amount, maybe $20 or $100 per month, they set aside funds for that. You calculated the number of people they have on their social security number. They can say they will give you $100 today and you don't get it today. But Nigeria, they say they will give you money today. Maybe it's another building in another country that will collect the money. This building will be saying, your name matches another person's name, blah blah blah. We are not even sure. We are not even sure the money will even be disbursed to any building self. You get, so they have foundations in place where they can shock some of these effects. Sadly, in Nigeria, we don't. So anything that affects us almost has a ×4 effect in Nigeria compared to how the other countries manage it.
So at the end of the day, US is the safest.
Yes, those countries' currencies are still the safest. There's no debate about it. It's just that now they are beginning to shake. But no matter how they shake, our own is dancing, our own is running up and down. There's no between shake body on the spot. And everybody that is running up and down. So that's it. Okay, so another thing to do is you can say, okay, I want to invest my money in interest-bearing securities. So I put my money somewhere. So I can say I want to invest this 16,000 in something that will give me, for example, 20%. Right? So I put this 16,000, 20% of this is what? 3,002, for example. This is 19,2. So I will collect my 19,2 and use it to pay the other. You get? So I've kind of hedged my risk because I've invested this money in something that will give me interest. So the timing of collecting this money will match the timing of when I need to pay the other. So let's assume this one we spoke about is I want to buy something from the other. But let's assume I've already bought from the other in the past. And our terms of trade is that you pay me after 30 days. Right? So I bought it today and I need to pay him after almost March. So let's say 30 days. So I know that in 30 days I have an obligation to pay the other $10. Nothing concerns the other with your naira moving up and down. It's not the other's business. Pay me my $10. But I know that with the way FX is going, I need to hedge. So I'll go and look for an investment that will give me a particular return. I'll go and put my 16,000 there. Once it is April, I go to where I've invested my money, pick up my money, and go and pay the other. So basically, I've tried to cover that exchange rate risk with the return of this investment. Do you understand? Is it clear, guys? Yeah. So that's what this is trying to say. That's also what we call hedging of risk as well. Okay? So that's the story of this platform. So for FX, there are two sides to it. There is the sell side and there is the buy side. So the buy side includes companies because they have obligations in FX. So they want to buy dollar to settle their FX obligations. For example, companies buy spares, companies buy machines, right? You want to buy a machine from China or you want to buy raw material, right? You need to pay those people in US dollars. Where are you going to get US dollars from? We're in Nigeria. So you need to look for somebody that will sell US dollars to you. Collect the dollars from Tosin, for example, and give it to your dollar. So as a company, they are called the buy side because they want to buy and transact. I'm not into buying, as a company, I'm not into buying and selling of dollars. It's not my primary operation. I only need dollars to buy raw material so I can produce. You get, so I'm a buy side. Then you have investment accounts. Are people who hold it for.
This is the CFA test.
Yes, this is treasury.
Okay. I was using the same long time.
I use it curriculum.
Yes.
But you should see something similar to this. This one is just summarized. Okay? So investment accounts, mutual funds and the rest. So this one's your pension and everything. They try to invest your money so they can get returns a bit, blah, blah, blah. Then government entities as well. Then retail FX market, people that use FX for paying their children's school fees and all. Everybody is pressing for. Okay, oh. Then the type of exchange rates, which I think we know this, there's no need to speak English. But in terms of understanding what it means, so when you see 1416 USD slash euro, it means that 1 euro costs 1.416 USD. I don't need to explain it, we know this now. When you see Naira and you see 16 this thing, you know what it means. Okay? So, but what I need to make you understand is there's what we call base currency and price currency. So when you see 1.25 USD slash euro, the currency at the end is the base currency. The currency that doesn't have an amount is the base currency. But this first one is the price currency. That's what you need to know. And for everything we are doing, our answer always relates to the base currency. So if I'm going to say this 1.25 USD per euro, if I'm going to compare it with this other one, if I'm going to compare this and this now, my answer will be in terms of euro. Right? So I can say the euro has depreciated or the euro has appreciated. I cannot talk about the USD because the USD is not the base currency. Are you guys following me? So everybody will close everything now. Listen to me. Yeah, with me. So when I ask question now, you start saying, I do not know. Okay. So all my answer must be in terms of the base currency, which is this currency that doesn't have a figure in front of it. So when we say this is usually how we do our currency. So what's the base currency? The dollar is the base currency. So in some cases, if I'm going to answer, I'm going to say, so if this has moved from this to 17, my answer to this will be in relation to the dollar. I will not tell you the answer when we get further. But my answer with this will not be in relation to Naira. My answer will be in relation to dollar. So if they ask me, okay, what has happened here? I will either say dollar has depreciated or dollar has appreciated. I will not talk about the Naira. Do you understand?
It should be either dollar has appreciated in relation to Naira.
Exactly.
I feel like, you know what I'm saying is, I feel like that last line in relation to the Naira dollars.
You can add a relation, you can decide not to add a relation. But for you to say which one has depreciated, it's in relation to Naira because there are only two currencies we're talking about. But that first sentence of the answer is very important. To say it is the dollar, not the Naira. So here I will not say Naira has depreciated. Even though we know Naira has gone from 16 to 17, meaning you need more Naira to buy the same $1. But here I will say dollar has appreciated. For me to now talk in terms of the Naira, I need to convert this. So there's something we call direct and indirect rate. I need to convert this to, how do I convert it? I will do 1 divided by 1623. So somebody should tell me what this number is. I'll do 1 divided by 1623 here. I'll do 1 divided by 17. So somebody should do 1 divided by 17. Alright, let's go. All the phone you have been pressing since now. It's time to press it to calculate. Oh, yeah.
0.6161.
Eh?
0. 6161.
3 zeros. 0.006. Let's put it this one. This one will go 61. Maybe I will need the balance. What's this other one? 0.5. 0.005.
588.
So this one now is now dollar per Naira. This one is dollar per Naira. So if I'm going to say in terms of any depreciation or appreciation, this is what I will use. So, okay, let's come back to this. 17 divided by 1623 minus 1.
Which one is
17. This one, 4.74%. What's this one? This one like this. The same thing you did here. Just do it. This one you did this divided by this minus 1. Okay? So just do it. 28,000. That's the part. It should be the same, but it's not the same. The only thing I did was to invert it. What do we have? Where's 0.94? The same thing you did. Is it the same thing you did also? Yes. This one over this minus 1.
minus 0.05.
And so 5.8. 5.8%. So you see that there is a difference between this answer and this answer. I'll just give you a rough example. You still use these figures are very far apart. So this answer here is different from this answer. So what your exam will ask for? So this 4.74% is dollar has appreciated by 4.74%. But remember, this first one, dollar is the base. I'm saying confused with it. Let me take it back. The question only gave us this and this, right? The question now asked us, we should explain in Naira. Has Naira appreciated or depreciated? That's the question. But they only gave us this, right? But we know we cannot answer that question using only this, because Naira is not the base. Clear? So what we have to do is to convert, to make Naira the base before we now answer the question. Because the question asks us what has happened to the Naira. And remember I said every answer we give must relate to the base. Now to convert anything to the base is to do the inverse. If it was this they gave us, we don't need to do any conversion. We'll just do this and tell them that Naira has depreciated by 5.8%. Right? But they didn't give us this, they gave us this one. So we have to calculate back to this. So with this one now, let's assume it's dollar they asked us for this one. Our answer would have been dollar has appreciated by 4.74. It would be wrong for you to say Naira has depreciated by 4.74. That's what I'm trying to tell you. Because you have calculated this dollar it's 4.74, that should be the same. It will be wrong. You see that this figure here and this figure are not the same. So you always have to do this conversion for you to answer the question in relation to the base.
If you take that first one,
Yes.
say that dollar has Naira has depreciated by 4.7.
It's wrong. Yes. That's what I'm trying to prove with this. So it's only the dollar that has appreciated by 4. That dollar has appreciated by 4.74 does not mean Naira has depreciated by 4.74. That's what this is trying to prove. So for the dollar, it has gone up by 4.74. But the Naira has depreciated more than this 4.7. It has depreciated more by 5.8.
Yeah,
So
I guess it's mathematically like the way you said that.
So the first thing you need to do,
like practical.
This
like,
practical.
Maybe you bought goods.
so it's in saying you bought goods, you are not looking at this now. You are only looking at, I'm supposed to buy goods at local prices and buy it at local prices. So So you are looking at you have lost money, but you are spending more naira than you
You
should
can
have
say
spent.
that you lost certain percentage of money,
Yes.
right?
Yes.
And you can put it in percentage. And if you decide to put it in percentage that way,
So for you, you have lost 5.8% of the money, not 4.74%, because you are looking at your naira. So naira to a dollar.
it's somehow. But the naira appreciate good with like.
That's why I needed to show you like this before we get to it. Because the normal assumption is I've calculated 4.74 now, everything should be 4.74. But until you inverse it, where you see that this answer is always different from this one. This gap is actually a lot. But ideally, you see maybe this one will be 4.74, this one will be 4.9 or something. There's always a difference. And CFA will ask you. CFA will not ask you for this first one. CFA will ask you for the second one. The difference is that, so there are two currencies. So while your currency is moving, while dollar is moving, naira is also moving. So what it means is that, yes, dollar is appreciated, but there is still some elements in your naira that has made it worse. So this minus 5.8 minus 4.74, this is 1.1. Is that extra naira, the economic factors in your naira that has made it fall more than what is happening in the exchange rate? You don't need to learn on this one.
Let me say it like
You don't need to learn on this one. You don't need it for the exam. What you need, you don't need it for the exam. People don't even do this calculation. If you go online and they tell you exchange rate has changed, they will just tell you naira has depreciated versus dollar. Most times they don't give you the percentage. They just say naira has depreciated. Nobody does all these calculations that but you need it for the exam. So all you need to know is, first of all, when the question gives you this exchange rate, you ask yourself the first question: what is the base?
the reason why we need to scale.
So this one is the base. So I'll explain the normal one and I'll explain the additional thing once again. In this case, the dollar is the base. So if the question asks me, has the dollar appreciated or depreciated? I will say dollar has appreciated by 4.74. I am correct, because dollar is the base here. But when the question asks me, has naira depreciated or appreciated, I cannot use this exchange rate again, because I need to convert to make naira the base. So to convert, I need to do the inverse of it, 1 divided by this. Which are these two figures you people gave me, which I believe is correct. It's just an example. We'll still use it because numbers are correct. Now, I now need to check what has happened to the naira here. We know from here, we know that the naira has depreciated. We know. Our assumption was just that it has depreciated the same way the dollar has depreciated. But coming here, we can see that naira has depreciated more than what the dollar has appreciated. And I said, okay, there are some economic factors within your own country. Because at the end of the day, what is happening is that it's not just dollar movements. So yes, the exchange rate factors are, in some cases, dollar is just staying the way it is. It's our naira that is free falling, right? It's our naira that is falling and falling very fast. So the rate at which your naira is falling may be higher than the rate at which your dollar is appreciating. You get it? So naira is falling versus all currencies. Dollar, pounds. It's not only dollar that naira is falling. Free
Is
falling.
it possible for the currency to just fall in this one? Is it possible?
It's possible if that other currency too is falling. So let's say our naira is falling and pounds is also falling significantly. If dollar is remaining stable. So if two are falling significantly, we can see that, okay, well, how would you even know? It's okay. My naira to dollar from point A and point B has fallen by 2%.
Cross conversion. I think so.
Cross rate. We'll get to that. And you saw naira to dollar has fallen by 5%. But naira to pounds has fallen by 2%. And you start asking the question, dollar is stronger than sorry, pound is stronger than dollar. So if naira to dollar is falling by 5%, you would assume that naira to pound is fall by.
Most of the international transactions, they are not done with pounds.
Yeah, but pound is moving. How much is pound? Pound is more than 2,000. Yeah. So why is pound moving?
The definitely
What naira is worth.
yes.
So it's not because of
You don't really use pounds to choose.
So dollar is
pounds. Pounds shouldn't be moving in
That's
gold.
what I'm saying. It's not like that. You don't look at it like that. So there's also an index between the dollar and the pound. I hope you know that. I think it's 1.14 something. There's an index between dollar and pound. So when one moves, the other one moves with that factor. So if you check what our dollar is and what our pound is today, I don't know why I it is, but let's go to see that. Let's go to see that. So we concern of the dollar. Not concern of the pound. Pound is still no, pound concern you. You can't say nothing concern you with pound. So this is exchange rate as at 22nd. So you see dollar. Oh, sorry. So let's do something.
See what you are talking about? Yes. See, as of today, they don't have the exchange rate as of today.
No, they don't.
No, they don't. It's not daily now. It's daily, but it's not. You can't see today. Today is weekend.
Yeah.
No, today is weekend. Two. No, they don't. Today is 25th. 22nd was Thursday, so you can't even see 23rd.
What happened?
I
You
know.
see 23rd on
Actually,
Monday.
it's Friday.
You are not seeing. No, you see right on Monday. It's on Monday you will see. You will see a day after.
That one goes
You don't see life now. Things are changing. You can't see today because as we are talking now, 4:54, something will happen that will move it.
But there's a market that you should be seeing today. It's CPL.
But it's changing. It's changing frequently.
We know.
So you
But what I'm
can't see
saying
it.
is, you should be seeing live rating today on CPM portal.
No, you can't see it.
Any other portal you may not see.
You can't see it on CPM. Because
we show you today.
this is not time. This is not time. There's no time here. This is not. There's no time. This is February 22nd. It's not February 22nd. 12 p.m.
We can't go to CPM
Now that you're saying
portal
that,
and see.
Oh, you want to see
if
that?
We should now. We should.
why can't you be seeing
That's what I'm saying.
So-
So they are fighting and
You
working
need to
out
understand
these
that
rates daily.
there is FMDQ, there is CBN. Some of these rates, it's not all transactions that flow through the CBN. So sometimes, if you also follow Nairametrics, the rates these people will give you CBN and the rate FMDQ will give you will be different for the same day. No, sometimes it's a lot. Because CBN sometimes doesn't cover everything. It's not everything that passes through CBN, which is what CBN government is trying to do. There are some forex movements that does not pass through the bank.
Which is not supposed to be.
So that is the reality of today
They are
now.
telling you they are not even up to their game before.
So that's what he's trying to close. Because if he tells give you something at 12 p.m., how do you major cost?
What they should be doing, they are not doing. You know what
It
I'm
is
saying?
not that thing you want them to achieve. It's not a 1 day or 2 day thing to achieve.
Is it
You cannot bring all the money. Do you know what is flowing in this Nigerian economy that is not passing through the banks? It's not passing through the banks. A lot is happening outside. Aboki is only giving you daily rates because you are trading Aboki daily, per minute, per time. And because you can go to the site and say, okay, 1,004, you pick up your phone. I want to buy one last now. That's 1,004.
There's IIN now, which is regulated by CBN.
It's IIN. This one we are looking at is IIN.
So IIN is actually like, I feel like IIN
It's not live per minute per hour. This is what you get. You will not see exchange rate until tomorrow. Even FMDQ, you will not see exchange rate until the day after. People have to collect this thing now. Do you think there is a system where
I used to call some guys in the bank and they will can tell me, well, that IIN, this is the highest because this is just
They have those,
Like, I think
they have
that's
those
the
internal
bank
trap.
system.
Yes, but it's not open to everybody because those things change. If you go to some banks now, you start, you see exchange rates. Some banks, I don't know, I used to go to some banks, and it's not very good to fiscal bank. You will see exchange rates, you will see the number changing, but they don't publish it here like this. Because this was actually
There's
permitted.
lots of people publishing it like
What do you want to use it for?
it's this also
If they are publishing their own, I'm sure many people will be like, serious, no, they will be disagreeing with that market.
Okay.
Yes.
Oh yeah, they walk to CBN or walk to commercial bank and collect dollars. You are not going to use it. If, for example, it's just like when before Tinubu brought up this free floating of dollar, you will see dollar $900, but you can't get it at 900. You are just seeing it there as placeholder. When you need dollar, you will still go to black market and buy at 1.415.
Those rates
that
you
was
see
So the 900, you are just looking at 900. Would you ever buy at that?
Because you don't want to follow the process.
for them.
Yeah, that's because you don't want to follow the
Have
process.
you tried to get it? How long does it take to get dollars? There was serious scarcity.
If you fill your form, you will
You will
get
get
that.
There was serious scarcity.
Because you will get cash.
Scarcity now.
You won't get cash.
There was scarcity.
You won't get cash. Oh.
So there was scarcity. That's what caused the
You have to
issue.
fill your form at the bank.
And you get the video.
Your PTA.
That's because you are asking for small quantity. Dollar is moving in terms of volumes. When you come and say you want to pay school fees or you want to pay for a professional exam, nobody cares about your small dollars. One rich man can pay for everybody's professional exam in Lagos. It's small money. But when companies are looking for thousands of dollars,
There are provisions for companies that need much money.
they don't get it. Have you, your company, have you tried to get dollars those days CBN rate? Were you getting it easily? You will not get it easily now. Easily.
Just talk to your bank. Like talk to your RM.
Oga, it wasn't easy.
You want
Let me tell you.
Actually,
Some companies,
it wasn't
Well, it's not like you know.
now let me explain. Some companies
Especially I say like release it now.
some companies had LC obligations in dollars
till today, they are saying
for 2 years. Up to today, that LC obligation is still there.
yes.
Everybody will say, I want from them, I want dollars from bank. You will request for $100,000. They will give you $1,000. You will come next week, request for another $100,000. They will give you $1,000. That's what it was. They were allocating it.
Yes, I agree.
Yeah.
But
So if it's small dollars you're asking for, they will sell it
if
to
you
you.
request for 1,000, so if you request 100,000, they will give you 1,000.
Look at that.
Now, the next time they are coming, they can give you another 1,000. The next time.
But your obligation is increasing. You needed 100,000 today. Next week you need 200,000. Other week you need 200,000. And they're only giving you 1,000.
So what?
When will you finish your obligation?
So it also depends on the bank you are working with, right? If you have a good relationship with the bank,
It's not just like that.
and
What they do is,
much.
there are some big boys. Okay, you will not get much. There are some big boys that protect these dollars.
You too, you also like what I'm saying. If you have a relationship with the bank,
It's
you also
not by your
with
relation. You are not a big boy because what those big boys are doing, you are not doing it. They sit down and they have discussions on how they will share this money.
That's what I was telling you. Some big boys.
Some people are actually collecting major, right? Some
The
people
big
have
boys.
been collecting major.
This thing you are saying is not the reality. It's not what was happening.
No,
It's a dream, but it wasn't.
I'm saying what's happening. I'm saying what I've seen.
For your
Yeah,
company.
for my company.
Maybe your company is part of the big boys.
I can talk to my
How much are you getting? Maximum how
You're
much?
just like 100K. You're just like 1.1K.
Weekly.
Right? And every time CBN comes,
That's 2 weeks.
right?
2 weeks.
Yeah.
Already. 200K is for money. You know how many levels?
People are asking for that.
Okay, we can put for like 240 something,
Oh,
right?
yeah.
And
And they will give you what?
they will give us 100.
Which bank was that? Zenith Bank. You know, the problem is when.
Right? No, the thing is, now the bank we are banking with, it's not actually a popular bank. The bank we are banking with, right? We tell them that we are like one of their major stakeholders.
So maybe that you are the only people that
So it's not like we are. So if they did not
maybe
do
there are
us
some
well,
things
yeah,
the
exactly
bank
what
is
I'm
also
saying.
doing that you are not aware of. But in the real sense, when dollar was 907, it was difficult for people. I said people had obligations in dollars and you were seeing dollar going up. People were saying, if you give me the dollars today, I will settle all my FX obligations. I have naira.
Till today, they are still saying
I have naira. Tell me dollars is available. I'll give you the naira. You give me dollars, I pay my vendor. It wasn't available. That's what was happening. It wasn't available. You go and bid for $2 million. They'll be giving you 100K. When do you want to finish settling your obligations? And it's not only you. Different companies.
Now, that's one of the
So that's the reality of this. So whatever they put here as at then was not what was translating in real money needing dollars. So you say you want 900. You see all the people that are influx trying to get $900. So some people say, my obligation is waiting for me tomorrow. Let me just go and do a booking, collect my money, settle my obligation, and move on. So at the end of the day, if you come here and you say you want to be looking at live this thing, it doesn't help you as a trader of dollars or somebody using dollars. You just be seeing dollars here that you can't use.
So now, but with that new regulation that they are doing now, with this new regulation, they are going to.
That's what Cardoso is trying to do. So Cardoso is trying to say, let me bring everything into CBN. So that whatever you see here is what you are getting. Yes. And then I also have enough dollars to even settle the obligation. So all these ones, big companies are looking for dollars. I will be able to give them dollars. Then they settle the obligation. Then with that, price will crash. BDC too will crash. That's the normal thing. But whether it will happen is a different thing. But that's the normal case.
Come to think of it, all those BTCs. Okay, yes, CBN needs to give them application, right? But I'm sure as the application CBN is giving them, it's not as much as what they are transacting now. So where are they getting the?
That's what I'm saying. Those that give them, those are more people.
So CBN will give them money. Some people in this Nigeria collect dollars from transactions. People that export and they get dollars, where will they change their dollars to naira? Go to BBC. Give me my naira. Some people are always transferring. So
It's coming directly.
Yes. Yes. So once those things are coming straight to this people. Some people bring dollars with physical bags.
Yes.
How do you want CBN to track that one?
I said they make it illegal now. You know, before, these ones that were supposed to be giving travelers, the BDCs, they were only for travelers before. Not to travel people that
Yeah, you change your money.
So that's what they were for. Before, so except they now make their activities illegal now. That is the only thing. But you have corrected. See, they will increase their database. They are giving them more power. I said they were going to make them illegal.
You can't make them illegal. This is also the problem we have in Nigeria. You cannot come as a government and be taking away capitalism when you are not providing anything. BBC,
you have said
yes, you're not providing
anything.
BBC is a business now. Imagine if I was doing BBC. It's not easy illegal. Are you collecting illegal money? You're collecting normal money. You're just doing a transaction. Collect from this person, give this person, make your spread.
You have said investing. The person is decide to produce something.
So you cannot come and tell me don't do this. It's just the same way government said reduce cement price. You don't just come and be making statements. People are doing legit businesses. So you cannot come and be telling me you want to control my business and you don't want to give me any benefits. Let's move on. We discuss Nigeria too much. Anybody that watch this video will think that it's Nigeria economy we are discussing. Let's move on.
I'm making us now. This year we can't pay for it now because of the.
Let's move on. It's not Nigeria that's here we ask for. Okay, so I've explained base and this thing. So let me see. Okay, so we now have nominal exchange rates. Okay, I've explained direct and indirect. I hope you got that. Direct and indirect quotes. Exchange rate is the price over base, which is the normal one, which is the direct quote we sell. Indirect is when we convert it, when we do one over that's the one we did, that's indirect. So understand direct and indirect. Okay, then we have nominal exchange rate. Excuse me, in most of your courses, anyway you see nominal and real, the difference is always inflation. Nominal includes inflation, real does not include inflation. So anyway you see nominal exchange rate, nominal rate, real rate, just think about inflation. That's the difference. Okay, so I want us to go to real numbers so that I understand that you guys get what I'm saying. Okay, so let's look at this example. CPI of US and UK are both 100 and exchange rate is 1.7. So for this now, which one is the price currency?
Dollar.
So see, I changed it because I don't ask you for base, I ask you for price. That's CFA. So dollar is the price, pounds is the base. So if we're answering this question, for example, we need to answer it in relation to what? In relation to pounds. So this is the current exchange rate today. 3 years later, the exchange rate is now this. Between this and this. And the CPI has risen to 110 in the US and 112 in the UK. What is the real exchange rate at the end of the period? So the real exchange rate is this 1.6, which is the current nominal exchange rate, versus the changes in the CPI. The CPI is Consumer Price Index, which is inflation. So inflation has increased. In the UK is now 112 versus 100. So based on this, our exchange rate has now moved to 1629, which means that the US goods and services that cost 1.7.
Thank you for this explanation. This price is blah, blah, blah. I think it's certain
It's only economics we see that. I realize people don't really look at it that way. Just move on. But in economics, we need to look at it that way. Okay. People that look at it the other way are maybe people that do forex trading and all this. So they have to know what's happening with dollar, what's happening separately. So we know where you have to see your money. So if purchase in the UK and real exchange rate has fallen, the decrease in the real exchange rate over the period is less than it would have been if we the cocoa here is, so this formula is what we need. Real exchange rate is the nominal exchange rate multiplied by the CPI of the base currency over CPI of the price currency. It's just this formula you want to get. Don't speak any of this. So to get the real rate, nominal times base over price. Also, the question can ask you for nominal rates. So you need to be able to make real rate the subject of formula and transpose it. So please note this formula, very, very important. Okay. Spot rate is greater than today, which is I want to buy something. You know the example again, I want to buy something from the other today. I'll pay the other today, that's the spot rate. So a forward exchange rate is I want to buy something from the other in 30 days. So the exchange rate will discuss agree today for 30 days. There's a difference of that. Good. So this is where I was going to. Calculating the percentage change in FX value of the currency. This is very important. It always comes up. But it's very easy to do. This is the one I was trying to explain to you guys before. So consider the USD to Euro exchange rate that has changed from 1.42 to 1.39. What's the base currency here? Euro. So okay, so exchange rate has moved from 1.42 to 1.39, right? Now see how it was calculated. The percentage change in the dollar price of a euro is simply this over this minus 1, which is that calculation you do. Remember, this divided by this minus 1 is giving us 2.11%. So this is what you would have gotten with your calculator, minus 0. Something. Then multiply by 100. So just move your 0 to places. It gives you 2.11%. Because the dollar price of the euro has fallen, the euro has depreciated relative to the dollar. You see the answer? They said the euro, which is the base, has depreciated relative to the dollar. You see, we did not talk about, see that English I said, where you said relative to the dollar. I say, in fact, you can decide not to put it. If you want to put it. But the cocoa is, we are talking about euro. It's the euro that has depreciated, so it's minus. Therefore, euro has depreciated between this to this. Where is it? Because the dollar price has fallen, the euro has depreciated, and the euro now buys 2.11% fewer dollars. it is correct to say the euro has depreciated by this relative to the dollars. So you need lesser euro to buy dollar because this has come down. Now, on the other hand, it is not correct to say the dollar has appreciated by 2.11% because dollar is not the base rate in this calculation. And what CFA will do, they will give you this thing and they will ask you what has happened to the dollar. Because it's very easy for you to do this calculation and say, oh, my answer is 2.11. But CFA does not like easy routes. They will ask you what has happened to the dollar in this one. Are you getting where it's coming from? So, it is not correct, blah, blah, blah. Until to calculate the percentage appreciation of. So, we know the dollar has appreciated. We know. But we cannot say it's 2.11% that it was appreciated by. So, if the question did not give you percentage, and you look at this, you say, okay, yeah, the dollar has appreciated. You take your answer and move on. But once they ask you for percentage, you must do this calculation. So, our beginning quote of this becomes, so you have to do 1 over this and 1 over this. So your new this thing will now be 0.7194 euro per USD and that one. Because you need to make USD your base. Using this exchange rate, you can calculate the change of dollar as this 7. So it's the same thing we did. This second one divided by the first one, same thing you did here. This second one divided by the first one, exactly the same thing you are doing. So that's what they've done here. This over. So you see that you have 2.16. So in the example, you're assuming this was the question they were giving you. They will put that 2.1, this 2.1 you calculated, they will put it in the option as positive. They will tell you US has appreciated by 2.11. And if you have calculated this one, you stop here, you tick it, and you think you are correct. If anybody call you outside, you'll be arguing. It's correct, it's correct, it's correct.
What is it that actually one has appreciated and one has appreciated?
Yes.
What's the value?
Bam. Bam. So you have to always ask yourself, the first question you have to ask yourself is, what is the base in this question? And what is the question asking me to calculate? So if what the question is asking me to calculate is the same as the base in the formula, fine. But if it's not the same, I need to convert to what the question has asked me to calculate. So that's this one. So you see 2.16. So it is correct to say the dollar has appreciated by 2.16 with respect to the euro. Note that for the given exchange rate, the percentage appreciation of dollar is not the same as the percentage depreciation in your hand. So I needed to point this out very, 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 very clearly. Very clearly.
Okay. To that point, so you said you are going to explain when you are going to explain what it means that the dollar is appreciating, so that the naira is depreciating does not mean that the naira is depreciating in respect to the dollar. Does not mean that the dollar.
That's what I just said. That's why I made that statement.
I said there is
appreciating.
No, it's the percentage.
So it's a value.
So if one is depreciating, the other must be appreciated. Because the two rates are there. It's just the rate. So you see one is
that what you meant when you said that?
Yeah. So you see this one is depreciating by 2.11%. You would assume that the other one will appreciate by the exact 2.11. But we have seen that it's not the same, 2.16. That's why I say you see that the gap is not too much, 2.11, 2.16. But the calculation we did, our gap was much between 4 and 5. Yeah, but here you see that this one is appreciating by 2.16. But this one is depreciating by 2.11. So there is a small gap. So that 0.05 is other factors that is inside the economy.
So that means for us to really know whether a currency is getting stronger, right?
You need to make it the base what it is.
Like for us to know whether a currency is getting stronger or it's getting, we need to always compare it to another currency.
Yes. You cannot look at your currency in isolation.
In isolation.
Yes. Because you are not living in your own world. Okay? So number 3 and 4. So answer it to your notes. Number 3 and 4. We have 2 minutes. They are very simple things. 2 minutes. So now we are.
Like everyone has seen this.
Which one don't you understand? These are easy maths. If we tell ourselves the truth, is this not easy math? If you have this in the exam, what do you dance?
I get number 4.
You get number 4. Number 4 is the harder one now. You understand the other one? Yeah, I have no problem. Sam. BC. BC. Wahala today. Alright, so number 3. Suppose that the quote for British pounds in New York is USD over this is 1.8. What is the quote for this over this? So you don't need to add it. So this first one is USD over pounds. Now they want you to do pounds over USD. You just turn it upside down. 1 over 1.3117. That's all. Abi? Am I wrong? What's our answer?
You know what confused me? What is the quote of US dollar in London?
You don't need all those things.
When I'm seeing New York, I think it's right in London.
You don't need all those. All the 2 things are they're giving you USD over pounds as this. They want you to calculate pounds over USD. Put on, don't swap it. So 1 over this, what's the answer? D. Okay, that's why we are looking to change it. So B. That's all. Now number 4. Those if you say this number 4, if you pay me, you owe me lunch. Canadian exchange rate and the yen give all these stories. What I need is JPY over CAD is what? 75. This one now move to what? 78. Abi? What is my base currency here? CAD. Good. Now, I'll now go to the question. The CAD has fantastic. Abi? They are telling me to calculate based on the base currency. So, what do I do? 78 over 75 minus 1. What do we have? What do we have here?
Straightforward.
Okay, 78 minus 75.
Something good from the back to 78.
Just put 4. Okay?
Like, it's obviously appreciated.
Okay.
And
So-
you only have one appreciated them.
You have to appreciate the sign. You people are using scope to do CFA. You need to be detailed though. These are easy 1-1 mark. Oh. Don't miss it. So it has basically appreciated by 4%. Now, this question is very easy. You know why it's easy? Because they did not give you 2 options that it has appreciated by 4. In the exam, let me tell you, this B would be appreciated by 4% and this has appreciated by 3.6. What that means is after you calculated this 4%, you'll be forced to calculate the other side. But if you have used your eye to do 4% and you see 2 options with 4%, how would you know which one to pick?
You know, I was sure about that 4. So once I saw appreciated by 4, I think I'm doing it.
So now let's calculate the other side. Or everybody calculate what percentage has the other one appreciated by. I know it's 3.8, but let your calculator show 3.8. Punch it. I'm asking you now because when you get a question, you will think you know it. Punch it. See how long it's taking now.
0.8. I calculated 0.8. That's 0.8.
See how long it's taking to calculate it. This is supposed to be a 30 seconds question.
You don't know.
See how long it's taking you to calculate it.
It will take long.
It's not supposed to. No. It's not supposed to take you long because there are tougher questions that you use more than 1 minute for. That's what I'm trying to tell you. There is the knowledge part of CFA and there is the time management of CFA. So all these easy question, you should be doing them like this, so that you will have enough time for the tough ones. Okay. So 3 and 4 is what? B and C, right? Let's see our answer. B and C. Exactly. Alright, so let's move on. Okay? It's a simple question. Yeah?
The X is still it.
I'm listening. Listen, you agree? Very simple. But it's taking you too long. It's taking you too long. This is the how many minutes question? Oh yeah. Sharp. Number 2. People see all the story we've written for something that is see why curriculum is always long. Number 2, let's go. What's happening? Oh? B A. Who's next? You're done. Let's move because of time. So the answer is A. Why? Yes. You say A. How to be A? 1 over. Yeah, so that's really simple to be done. So how come? Let's see. I need more questions. You know I have more questions. Alright, so managing exchange rates. So here we'll talk about different countries. So exchange rates, describe exchange rate regimes and explain the effect of exchange rate on international trade. These are basically so we have a situation where we said some countries index their currency to the dollar. We spoke about that. Some countries have their own currency. So you have a situation where you have countries that do not have their own currency. So countries that do not have their own currency are members of the monetary union. So what does that mean? They use a similar currency. Like the European Union, they use euro. So all the countries they use euro as a similar currency.
So that means does that mean they get their currency from you?
Yes, because they've indexed it to euro. As euro is moving, their own currency is going. That's what's that. So they have indexed it to. So it's like a common currency. Remember we spoke about different collaboration of countries. Said some that are monetary, there is free trade and all those things. So this one I've said, let's come into a combined common currency. So everybody in the Eurozone, the European Union are using euro as currency for transactions. They have countries that don't have their own currency.
That person, you just said 2 and 7, I said 2 and 7.
2 and 7.
Yes.
Yes.
The first line.
Okay. IMF categorizes exchange rate resume to the following, which include 2 for countries that do not issue their currencies and 7 for countries that issue their currencies. But it's just talking about the list of different types of policies. So this one are countries that have their own currency. Currency board arrangements to exchange domestic currency for foreign currency. I don't want to waste time with all this because we are not really needed. So conventional fixed peg arrangements. So this is the one where you will peg your currency against another currency. So that as that currency is moving by 1%, you'll show you won't move by 1%. So that you just be following that currency side by side. So this is like a lot more difficult to true in real life. Because the economic policies have to be tied to that country's economic policy. Your goals has to be initially tied to
You can't
that.
say because one country going to appreciate something.
So you now and
So
so
they don't work like
it's
that.
not in reality it's not that easy to do because that country can be bringing up a policy where
Except
the economy is
Like,
so you might be following the same
policies
uh,
supporting the economy.
it will dictate it in your economy. But it also doesn't mean you get the same
You get the
results.
same effect.
So
Really might be different.
there are some things that are just for both. You try to achieve it, but you don't get the exact same effect. And you have target to running them. I leave all this stuff for you to read. I don't want to speak less English. Okay? Balance of payment. The balance of payment is where capital flows offsets any imbalance between the export and import. So for every country, you export goods and you import goods. So they are usually movements in FX. So what you do is you ensure that the capital movement between the two countries match your export and import so that everything goes like so that will become balance of payment. So sometimes it doesn't balance. Sometimes you have more imports like in general, we don't have balance. Because you have more imports than exports.
So you try to make, I would say you try to make your import payments equal to your exports.
Something like that. Or while you are doing where there is a mismatch between that, you balance it with capital flows. So if for example your imports are more than your exports, you have to balance it with movement of capital between the two countries. So that at the end of the day, if this one is higher, this one is lower, so that there is a balance in it. Trade deficit too is the one we just trade deficit is the export and the import part. So the trade deficit links to your balance of payments. So of course we know Nigerians have the trade deficit. Capital account deficit is the we said import and export, which is trade deficit versus capital inflow. So capital inflow can have a capital account deficit. You get it. So you have to balance it. So that's what they are saying. So here in China for example has a capital account deficit that offsets the trade surplus with the US. So in the trade surplus, they are exporting more than they are importing to the US. So they have a positive trade. So exports is greater than imports. Because this is greater than this, you have a surplus. Right? Meaning that you are getting more money from this one. Now you are balancing this with capital. So the capital flows between the two of you. So to balance this surplus, you need to have a capital deficit. And what is the capital deficit? It means the inflow of capital is greater than the outflow of capital. So where you have this shortfall, you are receiving a lot of money from exports here, but you are balancing it by the capital deficit, the shortfall of this. So the two must match. You know, I said the trade and imports, the balance it with your capital. So when one is high, the other must be low, so that they meet in the middle. That's basically what this is. Okay? Clear? And this is also what they are talking about. So the exports and imports versus private savings, investments. I don't think we need all this one. Those the old syllabus. The intuition of the trade deficit, which is the set of the old syllabus for the so this is the question. This is part of the content. Sorry, is the demand and supply of the syllabus. So we spoke about this. So we need this one. We talk about private savings. No, we did. We spoke about this part where we said where there is money in circulation, how does it affect private savings and how does it affect physical capital? We said if there is a lot of money in circulation, companies will spend money. Remember I was talking about that. Companies will spend money, they will increase their investment. when there is no money circulation, they reduce their investment on capital. Then we spoke about the tax revenue and government spending, the fiscal policy. This part is fiscal policy. Where we said government spending is good for us because there is no money in the economy. Tax revenue is not good for us because government is taxing us and they are getting revenue. We spoke about it. Okay? So that's common objectives of capital restrictions. I'll just go through this. The basic thing in this currency exchange rate is just understanding this currency stuff we have spoken about. That you guys haven't still gotten 100%. Then understanding your nominal rates. I need to ask questions. I need to get some questions about that. So that we can close that. Okay? Any questions? So your last reading, which is very easy. I think we already mentioned, I think it was Sam that mentioned cross rate already in the past. So this is where we talk about cross rate. So cross rate is exchange rate between two currencies. So you know before we have been talking about two currencies, Naira, dollar, USD, euro. So now we are adding a third and a fourth currency. Okay? Let's pay attention. We're almost there. So you have two currencies here. You have MXN over USD. One class. Okay. So first one is MSD over USD. They've given us this currency. What is the base currency here? USD. Thank you. They now give us another currency, USD over AUD. What's the base currency here? AUD. Now they now say we should calculate the cross rate, which is MXN over AUD. So all you need to do here is we are basically cross multiplying. Basically mathematics. Don't need to overthink this. MXN over USD is the first currency they give us. The second currency they give us is USD over AUD. So if this one cancels this one, it means I can get MXN over AUD, right? Right? So because this cancels this, I can multiply whatever I get here, 0.6, I can multiply it with this one, 10.7, and I get my answer, 6.4. Clear? This is simple. But if they have asked me to calculate USD over AUD, I have a problem because if I cross multiply this, it doesn't give me this. So the question is, how do I transform these things I have into this? Who can suggest?
So did you say USD over AUD?
Yes. It's not what they asked us here. No, this is our own question. We have answered what is here. We are bringing our own question. So if they ask us to calculate this, what do I do?
How do you guys say?
Good. So I inverse this because this one already has my denominator. How do I inverse this? How? God bless you. So I will do 1 over MXN over USD. This will now give me USD over MXN. I can now multiply. Does this solve my question? It doesn't solve my question.
Yes, you already have that one.
Does this solve my question?
You already have USD.
Oh, we already have USD.
That's what I was saying.
We already have USD. Okay, let's change it to. Can we change this one?
There's nothing to change here.
There's nothing to change. Okay. So the cocoa is whatever we have to do. If we needed to inverse this one, for example, if we wanted to make this USD over MXN, but let's inverse this one, and this one will now be AUD. Yes. If they ask us to do AUD over MXN, yes. If they ask us to calculate this, compound it. We will inverse this one, So we inverse this USD over MXN, then we inverse this USD over AUD over this. So this divided by this will give us the AUD over MXN. So what does that mean? We will have done 1 over 0.6 times 1 over 10.7. That will give us our answer to this. Good? Yeah, found it. But you get this, have you? So of course, like I always tell you, CFA will not ask you this easy one.
It's the same thing. You say MX.
It's the same thing.
No, what you just have to do, just impacts your last answer. What you got
This 6.42.
yes.
So whichever way, but CFA will not ask you this one as easy as this. That's what you need to understand. They will always try to ask you to impasse. It's easy, Abi. No answer now because they know how to ask them questions. Alright, so this is 6.42. So our first question. Let's go. Sharp. So we have, always forget all the non-money answers. Don't be reading, just go to the exchange rate. Yes, sir.
If they give you a
Yes, sir.
if they give you an exchange rate directly, they said MXN AUD is equals to 0.12 something. Is this direct or indirect?
It's direct.
It's direct.
It's direct for AU.
Because what I'm seeing is that the pattern I've been seeing is in money is that for all the direct quotations that I've been seeing, like the figure they are always giving us is always like
It's higher than one.
Yeah, it's higher than one.
So most times in this exam, they will give you more direct quotes.
So my question is, does not mean that direct quotes is always higher than one?
No. The direct quote is the one we want to make as the base. So the AUD in this case is the base. So this is a direct quote for us. When you now inverse it compared to this, that now makes it an indirect quote.
So if the question comes and saying,
If the
if the question
question
tells us explicitly that MXN is the base, then this becomes an indirect.
exactly. So it's based on the base, the code that relates to the base that makes it a direct quote.
So what the question is, so if the question does not specify, what we see as
That is a direct quote. Sam and the other
Can it be asked? Can
I
it
expected your answer
that much?
they can't twist it. So they will always give you an exchange rate and tell you what it is they want to calculate. So the exchange rate you are seeing, just find out the base. Then you go back. Sam and the other, I got to answer from them. Have you were listening to our question? That's the excuse you give us. But yeah, this is a sharp question. But on a serious note, I need us to improve on our time. Time is one of the things that affects people in CF. Sometimes it's not the knowledge. They know it, they just discover that once they tell them 15 minutes, they have not even started. Yeah? 4.0 what? Let's see that. Let's see. Maybe I know that one.
4.79, that was
There's 2.79 I got. But you say 4.0, I'm not doubting myself. 1.0 is plenty. We are starting from we are doing 1.7, we are doing 2.25. So
I didn't get so fast.
I just did this divided by this. That's all.
That's just
So let me give you the technique. So what did they ask for? CHF over USD. This is what they gave us. Times what? NZD over USD. This is what they gave us, Abi. And they want us to calculate CHF over USD. Meaning the only thing I need to inverse is this one now. I need to do 1 divided by this so that this one will now become USD over NZD so that I can now multiply. Right? So I expected for you, this is it's my experience. For you, I expected that what you would do is you would do 1 over 2.25 first. When you get that one, you now multiply it by 1.77. Abi? No problem, that's your level. So take it a step higher. Because I know that my numerator is 1.7799. I want to do this times 1 over 2.2529, right? Instead of punching all this in my calculator, I just go to my calculator and do 1.7799 divided by 2.2529. That's all. So instead of multiplying, I'm just dividing. So this is the only thing I punch in my calculator. I gave me 0.79 in fewer seconds than you. I will now apply to go and do other questions. That's the finding I'm telling you need to learn. That's why you're in class. I'm not reading it. Biodun, how did you get 4? Did you add the 2 figures? Which one did you reverse? So you did 1 over 2.25.
I just say 2 divided by 2.5.
You did 2.25 divided by 1.776. Why? The 4 is not coming out. The 2.25 divided by 1.7 will not still give you 4. Did you calculate it? Or 4 just came to your mind? Okay. Is this my example clear? So there are 2 things you would always do in the question. Either you are multiplying them or you are dividing them. So instead of doing this one here, I just go straight to this. Doesn't say it's experience, but you can learn the experience. I just go straight to this. Well, how do I know I need to go straight to this? You see, I've told you I'm not looking at all the English. I'm looking at 3 things. First, what did they ask me to calculate? CHF over NZ. So in CFA, always try to read the question first before you read the option. That also saves you time. You read this before you read the story. Or else you'll be lost in the story, you now go and read the question, you go back and read the story again. You don't have that time. So what did the question ask me to do? CHF over NZ. Okay, fine, I go back to the question. What is the first figure they've given me? I look for the first figure. Okay, this first figure is CHF over USD. I already have my numerator because this CHF here matches this CHF. So I have what I'm going to put on top. So the question is, am I multiplying or am I dividing? How do I know that? And I come to this. Here's the second figure. I look for it. Okay, this is the second figure. 2.25. What did they give me? NZD over USD. Is USD here? Is it USD here? No. It's NZD. So the NZD is the numerator here. So meaning I am dividing. If here was USD over NZD, I will say, okay, CHF numerator here, NZD denominator here, and multiply. But because I know the denominator here is not what they asked me for, therefore I need to divide.
It was USD, you just have picked 2.2 and multiplied it.
I'll just multiply this times this.
1.7 times 2.2.
Yes. Because if I do the cross multiplication, I'm only teaching you this because we're in class. After now, you are not using this again in your calculation. You need to be direct because this is a 30-second question.
You need to be able to spot it.
Yes, you need to be able to do it quickly the way I've done it. So instead of coming to do cross multiplication, you mentally do it here, which is this is what the question has asked me. Abi? This is the numerator, this is the denominator. The first one is does the numerator match? Yes, fine. The second one, does it match? If it was this over this, I know that this is my denominator here, this is my numerator here. This over this is this over this. I multiply. But I see that it's not the same, so I need to inverse this one to get what I need. That's all. Okay, oh, they are looking at me.
Take a lot of practice.
It doesn't take a lot of practice. Then for now, you're doing your cross multiplication. I tend to get it now, but I tend to take a bit more time than it's taking me. When I'm afraid you are not getting it.
Get it?
Okay, good. So you now have to move from that stage of cross multiplication to this direct. Am I multiplying? Am I dividing? That's what you need to ask yourself. Am I multiplying? Am I dividing? You are only multiplying where the two of them match the answer. That means the numerator and the denominator in the question matches the answer. You don't need to inverse anything. But when you need to inverse one, then you know you are dividing. Clear?
That's pretty straight.
Alright. Okay. So arbitrage relationship. So arbitrage relationship is basically where you are looking for opportunities. So for example, in a situation where you have 2 markets, if I sell something 15 naira in this market, I should be able to sell it 15 naira in the other market. But if I sell it 15, just I think somebody put online or was it rice? There was something the person said that if you buy it in Abuja, it's 50,000 for example. If you buy it in Lagos, it's 70,000. So let's use that example. Let's say for goats. No goats is expensive. I was hearing online that one cow is like almost 1 million.
They are selling our rice. Oh, no, not our rice, our food. PMS that the price are fixed.
Exactly. So that's why they smuggle, even cement too. They try to smuggle cement out of Nigeria. Cement and fuel. Why are they doing that? Because the price at which they are selling it there is higher than the price at which they are selling it here.
But they said cement is cheaper outside of Nigeria.
Outside Nigeria, not neighboring countries, not African countries, but it's abroad. It's cheaper in those countries because they have better machines. Gas is not affecting them like this. Fuel is not affecting them, so it's cheaper. So if I can buy something, for example, 50 naira in Lagos, and that same thing is 30 naira in Ibadan, this is already a business opportunity, 20 naira. Sam, you are not with us on this class today. This is 20 naira. So the question is, if I buy it in Ibadan for 30 naira, and I'm transporting it to Lagos, if my transportation cost and everything, all my cost is 40 naira, it means that what, there's a 10 naira to be gained from doing this, right? So I'll be doing this more often. So this is what you call an arbitrage relationship. The same products, you are selling it at one price here, all market forces, and this you are selling it at another price here. When you take in all the transportation costs and everything. So everybody will tilt towards moving it from here to here, right? But what happens, because arbitrage relationship most times doesn't last for long. If everybody comes into to gain this 10 naira, this 10 naira starts dropping, because there are a lot of options. It starts dropping until the 10 naira no longer exists, and then the market balances.
The price in that market will also go. Because there is more supply.
So the market kind of balances itself, and then this arbitrage profit or normal profit no longer exists. So that's what this is trying to say. That's basically what arbitrage is. So most times we assume that there is no arbitrage condition. So when currencies are freely traded and forward currency contracts exist, the percentage difference between the forward and the spot rates is approximately equal to the difference between the two countries' interest rates. Remember I mentioned spot and forward rates. Spot rate is the rate as of today. Forward rate is the rate we are agreeing today but for a future transaction. So the idea is the difference between my spot rate and my forward rate should be the same as the difference between our interest rates of the two countries, so that it nils out itself. What does that mean? If I want to do a transaction in 3 months' time, and I carry my money today and I go and invest it somewhere, that interest rate they will give me for that my money I've invested, if I collect the money back, it should be equal to the forward rate in 3 months' time. Remember that example I gave you the other, where I said I can take my 16,000 today, go and invest it at 20%, right? I will get a return of, let's say 3.2, so let's say 19,200, right? 16,000 is the money I have today. I want to pay Biodun 9,200 in the future, right? So if I invest this money today at 20% interest rate, in 3 months' time, this interest is for 3 months. In 3 months' time, I will get 9,002, which I will use to offset the money I'm owing Biodun, right? This balances out, right? But if at this point, now remember the exchange rate here is 1,006, but the exchange rate here is 1,920, for example. So the difference between this 1,6 and 1,920 is nilled off by this interest rate, right? But if, for example, I'm getting 30% here, let's say this is now 20,000, and I need to pay this guy 19,200, so I'm making extra money here, 800 naira. You get? So this is where the arbitrage comes in. So of course, Biodun will decide that he pay me to do this investment, so I will get 800 naira, which helps me to balance this exchange rate effect. So this is the arbitrage condition. But like I gave you this example, this arbitrage condition most times only lasts in the short term. Because once everybody comes in and realizes this is the money you are making, that interest rate starts coming down, and then the arbitrage condition moves off itself. So that's what it say here. Percentage difference between forward and spot rates is approximately equal to the difference between the two countries' interest rates. This is because there is an arbitrage trade with riskless profit to be made when distribution does not happen. So you see that I'm going to make a riskless profit. There is no risk to this my profit of 800. That's the arbitrage position. So we call this a no arbitrage condition because if it does not hold, there is an opportunity to make a profit without risk. The possibility is you borrow currency A at interest rate A. This is what I'm basically trying to say. That's what they are saying. Convert it to currency B at the spot rate and invest it, blah blah blah. So what this is saying is that you will make more money. There will be an extra money you are making when you deal with the two currencies. If that interest rate gap doesn't cover it. That's what it is trying to say as a summary. So what you need to know is just to know this formula. Not the stories I've said, just get to know this formula, which is to calculate the forward rate, you'll be given a spot rate. So to calculate the forward, so you have these two currencies. So what is the base currency here? DUB, thank you. So consider two currencies, AB and AUB. The spot rate is this. 1 year riskless ABE is 5%, and 1 year riskless this is 3%. What is the forward rate? So you just do spot rate, which is this formula. Spot rate multiplied by 1 plus the rate of the foreign currency, which is the price, divided by 1 plus the domestic or the base currency. So that's the 4.56 times 1 plus 5% divided by 1 plus 3%. You know, this formula is similar to the formula, the formula we looked at today, where we said base currency is the one that we denominator, price currency is on top, multiplied by the nominal and the interest rates. If you remember, we looked at nominal interest, nominal rate and all.
They're telling us that this is the real rate.
So almost like that. It's the same formula, but in that case we're using inflation, but again we are using interest rates. So the spot rate is this times price over this. So the forward rate is 4.655. So what this means that if the forward rate is not 4.655, there is an arbitrage opportunity that will exist that people will take advantage of until the forward rate comes down to 4.65. Do you understand? So that's that. Is it clear? So all you need to know is this formula: spot times 1 plus forward, 1 plus the price rate divided by 1 plus base rate. So this is another example. It's basically the same example. The spot rate is this. They've given us the ABE rate and the dog rate. The dog rate is 3%, so of course, the dog rate, which is the base rate will be the denominator. The only difference between this example and what we have done before is that one before was 1 year. This one is 90 days. So because it's 90 days, you are doing 90 divided by 360 days. So this question has assumed that 1 year is equal to 360 days. For some questions, they will tell you 1 year is equal to 365 days. So the only difference between what we have done here and what we did before is that we are now, this 5%, we are now saying if it is for 90 days, how many percent will it be? That's the only difference between what we have done. Where? Alright, the other thing is you will be asked to calculate forward rate from spot rates. So they will give you, so there's a way to calculate it by points, and there's a way to calculate it by percentage. So here they've given us the spot rate at 0.731, and they've given us the points by 3.5%. So we divide this point by 10,000 to give us 0.00035. Then you add it. Because it's a positive here. If it was a negative, we would deduct it. If you were given a percentage, you multiply. So this is minus this, so you do 1 minus and then multiply. That's basically all for this statement. Nothing special. Alright, question time. No, we are tired. So I don't need to answer it. 1 to 5. I would have got 1 to 5. So say I need to. Do you even write that?
Yes, and guess which is well. I know this one.
Number one is
Have you guessed?
number one is
Oh yeah, let's go.
mine is 0.6.
I don't want to answer. Mark is 19.1. Is it 19.1? Is this one? Right? Oh yeah. Mark the answer. Number 1 is A.
Wait, let me tell you that.
A, B, B, B. Sharp. A, B, B, B.
That's it.
Oh yeah, score yourself percentage. Sharp.
Yeah.
It's past 6. I'm not going to do that.
It's already
But nobody should fail number 1. Nobody should fail number 2. Yes, you are in the lunch. Put percentage. Why is it only 12 answer one? Oh yeah, put percentage. Who has put percentage? I'm saying number 1. I'm saying answer by the side. Do you know which one to pick? The other one. I'm coming for the other one.
I did something on my phone.
On the other two. Okay. So number 1, nobody has to be number 1. Number 2. I would have loved for you to solve this on that time. That one and 2. Because you know it. But because there is no time, you balance and do it. So I told them, there's nothing for me to explain.
Wait, that number one.
Moving on.
Please wait, that number one. Let's solve it.
Oh yeah, Tosin.
Because what I got, that is I got 0.0006.
Tosin. Solve it up.
But I'm writing 0. Let's
Solve it. Take. Solve it on the board.
What did you say?
What's the answer for number 1?
0.66.
No, 0.6.
It's not the news.
Hey, that's why I beat it now.
Is that your answer to close the answer? Tosin. Hey, solve it on the board. Have you answered to his guess? Is it guessing to guess?
It's not guessing now.
Is it guess you guess? Guess go as Tosin has guessed, so my answer is closest to the answer they are picking. That's professional guessing. We have solved number 1.
I did this in the numerator. I do. So this one will not be the inverse of that. It's not really the inverse, so we just divided this one. I just divided it.
What figure do you write? 0.41.
From
So it's still all of you to get number 1.
it's not to me, I got it, yeah. I got it.
You all got it now, but the confidence, there's no confidence in this room about number 1. And I've calculated it on my phone now that I've gotten it.
What did you get?
I got the answer A, exactly.
Okay, is it not supposed to be 1.6000?
It's not 2.4, it's 2,400.
So that's not 2.2.
Sorry, come again.
No.
1 point what?
You see,
With us, we are using 1.1.
I was doing 2.4 something now.
We are using 1.6 and
And that was what I said.
Then go use the
I got
guess.
0.6.
So we always do another thing.
No.
that's the example where you are nice.
You know,
No, it's not 2.4. This 2.4 divided by 1.6. No, now.
It's 2.4 now.
First,
Now, see 2.4 was 2,400. That one is it.
Actually, it's 2,400. So it should be.
So I wasn't getting 0.000.
It should be 1.6 divided by 2,400.
So I'm just ensuring that.
1.6 abi.
The other one you get this answer.
No, I got the format is which is this ND over.
So it should be 1.6 divided by 2004. 241.
That's it.
How I say let's
Don't you want to scam?
get
Want to
to
scam?
7.6.
I want to scam you. That's A. Exactly. Okay. Number 2. Tosin, did you guess?
No.
Sam, did you guess on number 2?
I did.
You guess. Tosin, number 2.
Yes. I just did this thing.
I don't need story. Solve it.
No, like I did that already.
Oh, that is my method. It should be your method now. It's no longer my method. Just pick the answer from the option. Okay, yeah, it's correct. So NZD over SEK. So the first one is USD over, where is it? NZD over SEK. So the model will do USD over, so just multiply. Abi, Biodun,
Yeah.
you didn't get number 2. Why? Why?
Why not? I know it's not.
Okay, oh. You are knowing it after we have finished solving. After you have finished, you will now know it. I want you to know it before failing it. That's my issue. So guys, skills you go and practice some of these things. You see, they are very simple when you know it. So you can easily get mixed up. Okay? Any questions for me for today's class?